Welcome to the InterMarket analysis video update. This is a weekly video where we look at a number of different things. I go through the valuation of the S&P 500 historically and looking forward. We look at growth versus value. We look at the different sectors inside of the S&P to see how they're doing individually as well as compared to the S&P itself. We look outside of the market just to see if we can get some any insight or clues as to what's happening inside the stock market in general and the S&P 500 in particular. This is being prepared for Monday, September 8th. So first I'll go through valuation, both historical and looking forward. I'll do a pretty extensive study between growth versus value. We want growth to outperform value when the market's going up, and that's when it's more positive. And it's still doing that for right now. We've just been seeing a little bit of defensive shifting going back to about the beginning of August, but it hasn't come through as far as price action, at least yet. We'll also take a look at inflation, some different charts. Now we're going to get some inflation information this week with PPI coming out first this time, and then CPI coming out after that. But these are different charts of what does the market think as far as inflation. Then we look at some other markets outside of the stock market itself. We look at the 11 sectors that make up the S&P. And then, as I said, compare them to the S&P itself. We look at some different indexes. We look at correlations between different markets. Sometimes we can get some insight there. We look at some very long-term trends, mostly looking at monthly charts in that aspect, both with the S&P and then the NYSE, which is a broad market measure. And then at the very end, I go through a positive and negative list. If you've been watching these videos for any length of time, there's no changes to the overall positive and negative list. We have everything that I track on that list is positive. The only thing that's negative still is the US dollar, and that's been helping all the other areas to go up. Okay, valuation. This looks back. We have the scale 10, 15, 20. That's a static scale. It was developed, and it's more of a tradition to kind of stick with that scale. There's been other approaches to this, and I'll go through one right after this. But you look at this chart right here, you can see we're very expensive. The black line, that's the price of the S&P. And then just to get to a PE ratio of 20, we would have to go all the way down below 4,400, get into the 43s or so there. But we've been this way for a long time. I say this week after week after week. We don't use this as a timing mechanism. This is more just for informational purposes. So when somebody says the market's expensive, when you're just looking at the S&P 500, yeah, it is. But it's been expensive for quite a while. And as I also say quite often, it doesn't seem to really matter until it does. But we never know when that shift is going to come. And this is that same chart, but going back and highlighting some different historical things that have happened along the way and what the valuations were at that time. Now, this is one of the variations. This is Robert Shiller. He thought that, well, looking at an earnings report here and there, there's always some kind of outlier or something. Let's take a more smooth approach. Let's look over 10 years. Maybe we can get a better look at earnings that way. And he developed the Shiller PE ratio. This is also called CAPE, C-A-P-E. You also may hear it referred to as PE10. And then the value that's coming in right now, we don't really use that 10, 15, 20 scale on this chart. We just look at where is it right now at 38.93 and then compare it to what has the historical median and mean been. And again, for a number of years now, we have been way above the median and mean, almost double. In fact, even more than double. Okay, but the market looks forward, and these are the forward-looking PE ratios here. And this was as of Friday. They were all updated. This is put out by Edward Yardeni on his website, and it's freely available if you ever want to go check this out. But we look at the MegaCap 8. There's also the Magnificent 7, Illustrious 11, whatever you want to call them. But they're very expensive, but they also have good earnings. Now, NVIDIA's been getting smacked pretty much lately since they came out with their earnings report. Not because of the report itself, but because it wasn't as rosy looking into the future as the market had hoped. We've been coming down a little bit. We got up just about to 30, and we still use that 10, 15, 20 scale here. And so, yeah, we're overvalued, even looking forward, even projecting out, where earnings are more forecasts and just what they think is going to happen. And they try to be overly optimistic. Even using that as a foundation, we're still at 29.1 with the MegaCap 8. Then we look at the S&P 500, which is in red, still coming in above that 20 level at 22.1. And now we've been seeing some favor right now with the mid caps and the small caps. They've been hovering around this 15 level for quite a while. Now that they've been going up with price, the PE ratio is also starting to go up. It's still more reasonably priced. Now, if you're a fundamental investor and you use the PE ratio to determine if something is inexpensive or cheap or whatever, you probably like what's happening right now because fairly valued would be 15. We're getting a little bit above that right now, but we're not necessarily at the expensive part. But again, I don't use this for timing. I don't base decisions around that. I use this more, okay, if somebody says the market is expensive, either historically or looking forward, okay, I can back that up with a chart to show you. Then we look at growth versus value. First, we look at just growth, which is still in an uptrend. It came down to its 50-day moving average, but it held at that point, at least with this pure growth index, and is in a pretty solid uptrend. Now, we've been seeing value kind of kicking in gear. You go back to the beginning of August, and it was just kind of trailing along its 200-day moving average. Well, as we worked our way through August, we started to see the value going up, and that's where we're kind of anticipating that perhaps the market is becoming a bit more defensive. It's not like growth is falling apart. We're just seeing a little bit more favor coming into value. Now, this is when we look at these individually. Then we do some ratios between the two, and we look at a growth versus value ratio on top. When this is going up, that means growth is outperforming, and that's what we're seeing. And we're kind of dancing around the 50-day moving average. You can see where we were pulling back. And I was trying to point this out, not as any kind of a warning sign, but just, hey, look at what's happening in the market right now. It's tending to get more defensive as we started to get into August. And it's like, okay, if the market continues to get more defensive, maybe we're going to see a decline. That didn't happen in August. Well, we're kind of hanging out at these lower levels with this ratio right now, and it's actually improving a little bit. We're back above the 50-day moving average. But if this really starts to go down again, that might be that the market's starting to go down and the market is becoming more defensive. Then, just to get a little different perspective, we look at value versus growth. This is an inverted version of the top chart. And just to see, because sometimes the moving averages don't they don't cross quite at the same point. And we want to see confirmation there. Well, there's clearly in an uptrend on top, clearly in a downtrend on bottom, show you how value is underperforming growth. All right, then we look at some growth ETFs and some value ETFs, and we put them together, coming back down to the 50-day moving average, but still holding above that level. Growth is outperforming. Same thing, but inverted, showing how value is underperforming growth. What we've been seeing now for most of 2025 after we came up out of those lows in April. Then we look at a growth index and a value index. Growth is back above the 50-day moving average here. Value is under the 50-day moving average here. We look at a growth and a value ETF. Not really strong right now, but still hanging out at the top end of the rainbow. We're a little bit concerned because the blue line, which is a 20-period simple moving average, is rolling over a little bit. But mainly, I don't really look at that on this chart. I look at what are the lines doing in general. And for the most part, they're still going up. Then this is just an inverted version of that same chart. Values underperforming growth, even though we saw a bit of a pop once we got into August. And we break it out and look at small caps. Now, this is a little bit concerning. Small caps are finally starting to see somewhat of a sustained upward move here. They go up and then they come back, and then they go up and then they come back and go sideways for a while. Well, we were seeing a nice move up here earlier in 2025 with growth really outperforming value. Then we got into late spring, early summer, and we've just been going sideways, and now we're seeing this weaken just a little bit. To be more positive on the small caps, we want to see this ratio going back up and get back above both of these moving averages. And a similar thing, but not quite as negative here with mid-cap growth to value, going sideways recently here, but still below its 50-day moving average. And we've been seeing a little bit of an improvement here with the basic pattern when we look at the mid-caps. The one that I pay attention to the most is S&P. And you can see small caps, mid caps, S&P showing some weakness. Growth has been underperforming value in the short term, going back to about the beginning of August. But in the bigger picture, growth is still outperforming. So we haven't turned negative. We're just a little bit concerned. We want this ratio to be doing better than it is. And we keep an eye on inflation. This is long term, a monthly chart of the CRB index, which still is going up, and the moving average is going up as well. That could be considered inflationary longer term. But then we look down here at the inflation versus deflation ratio. We're not seeing this in the shorter term, but we are seeing this here where the inflation component is really starting to outperform the deflation component enough to start turning the moving average back up. Now, this is not going to be complete until the end of September, so really we're relying on where we were at the end of August. And for some reason I have this chart on here twice. Well, this was last week. This is this week, so still going up here. All right, then we look at a daily chart of the CRB index and see we're not really seeing any upward thrust. We are in an uptrend, but once we got into 2025, we pretty much have been range bound with the range getting smaller and smaller with the CRB index. We look at the Baltic Dry Index. Sometimes that can be a fairly good inflationary signal. Now, this is in an uptrend, but it's coming back down to its 50-day moving average. A little bit concerned about that, but we're not necessarily seeing that confirmed in other areas of the market. For example, inflation expectations. This is an actual ETF that you can check out. What does the market think as far as inflation? We had been coming up. Now we're starting to come down just a little bit here, and this actually declined in the latest reading. And we look at that same chart, inflation expectations, and do a ratio with tips. And we're seeing this coming down. This means that inflation expectations are actually underperforming tips right now. Now, when we see this going up, that's when we get a little bit more concerned. This is what was happening back in 2021. And then as we got into the bear market in 2022, this ratio was really going up. We're actually coming down if you look at over the last few months. So this just suggests inflation is not necessarily a problem. Then some of the other markets I was talking about, we're still in a downtrend with aluminum, but it has been bouncing back up. Corn continues to be in a downtrend. Wheat is also in a downtrend. That's not inflationary. Fertilizer had been going up, causing a little bit of a concern there, but lately it's been starting to come back down. Lumber, which is still in an uptrend, but man, it just went timber here and has fallen below both of its moving averages. And if it stays down here for any length of time, that'll probably generate a death cross. And this going down is also considered non-inflationary. Oil, I follow this mainly for geopolitical reasons, but you can see lower highs, lower lows. We're getting ourselves back into the low 60s now. And then we look at gold, which has been going up, and that's why this ratio is going up, and do a ratio with oil, which has been going down. And again, that's why you're seeing this ratio going up. And we look at the 10-year yield, which is black here, and that's been coming down, and oil's been coming down, and we can see usually they move in opposite directions. But right now, there are times, such as now, where they have a tendency to go in the same direction, which means if the 10-year yield is going down, then oil is probably going down. Until they switch and actually start going in opposite directions, that's when we would get a real low reading with this chart. Gas, kind of chopping all around, breaking down below $2 now. And heating oil, in an uptrend here, but not really showing any conviction, seeing a series of lower highs and lower lows for the most part. Natural gas also in a downtrend now. And diesel, which had gone up, that was a little bit of a concern. Now it's falling back. Now it's starting to go up just a little bit more. Again, could be potentially inflationary, but not showing any huge move like what we saw back in 2022. And copper, which I use as a barometer of the economy, we're down below both moving averages here, but we have been coming back up. Now, we were down on Friday with copper. We'll have to see if this improves at all. When copper's going up, that tends to be better for the economy. And so far, the economy is looking pretty good. But the employment report that came out on Friday was weaker than expected. And so copper's like, uh-oh, maybe we're not looking all that good going into the future. And it actually declined. And we look at a copper to gold ratio, continues to go down as copper's been going down and gold has been going up. Longer term version of that same chart, the black line here, that's the copper to gold ratio. We've also been seeing the 2-year yield in green, that's declining. And we're not really declining here with the 10-year yield. We're just getting to the lower end of the recent range that we've been in as longer term interest rates have been coming down. And gold, which does look like it broke out now. We saw a breakout about a week ago, and then it's been continuing to go up since then. And silver is also in an uptrend as well. Then we look at a gold to silver ratio here. This going down means that silver's outperforming. Well, it's stabilized a little bit here. And then we plot the US dollar index, and you can see the dollar's been stabilizing a little bit here. And we can see that there's a fairly high correlation between the ratio in the top chart and the dollar index in the middle. So that just looks at the interplay between precious metals and currencies. Then daily chart of the dollar going back down a little bit here, but it has potentially stabilized. We're not seeing any really big moves right now as we worked our way through August and now starting into September, but it's in a longer term downtrend. So the euro is in an uptrend compared to the dollar as the dollar's been going down. We also put the Japanese yen on this next chart. Really choppy lately here, but still in an uptrend compared to the dollar. And then I break it out. Here's the euro, where it came down, started to mess around with its 50-day moving average. Now it's back above that. And still in an uptrend, but a very weakening uptrend here with the Japanese yen to the US dollar. And the British pound also back up to its 50-day moving average when compared to the US dollar. Then some different indexes. And this comes and goes out of the daily videos. Not really seeing much of a disconnect now. When we look at the weighted version, which is the bar chart of the S&P 500 versus the equal weight version, so all 503 stocks are given the same weight in how that's calculated. When the red line really drops below the bar chart, that means there's just a few stocks that are really driving the market. When they're more matched up with each other, kind of like they are now, even though Google pretty much led the market this past week and Apple, we're not really seeing much of a disconnect currently. All right, and then this is that same approach here, but we look at an equal weight to S&P 500 weighted ratio. When this is going down, as it has been doing for the most part, that means the equal weight is underperforming. To say it another way, that means the weighted version of the S&P 500 is outperforming. And stocks to commodities, and you can see that the longer term chart that we were looking at shows commodities really outperforming, at least the inflationary parts of commodities. Well, here on a daily chart, we look at stocks to commodities, and stocks are outperforming. This is an inverted version of that same thing, just to see if we get any additional insight. We did come back up to about the 50-day moving average with this ratio, and then we started to decline again. We look at the NASDAQ 100 and the S&P 500, and the NASDAQ 100 has been lagging behind a little bit, still looking positive, still outperforming. Now, they're both doing good. I mean, we're near all-time highs with both the NASDAQ 100, and we set an intraday all-time high with the S&P on Friday. But over time, when the market's really strong, that's when we see this ratio really going up. We get a little bit concerned when this ratio is coming down, as it was doing in August. Now, it could be recovering right now, but we haven't really seen it cross back above the 50-day moving average yet. The S&P 100, which continues to outperform the S&P 500, that's more when you see that is in a positive environment. And the NASDAQ is outperforming the S&P. That's growth versus growth and value. And the NASDAQ 100 continues to underperform the NASDAQ. And as I point this out, as we were watching this come down, you could take that as negative, meaning that the NASDAQ 100 isn't having as much influence as it has in the past. You could take this as positive, saying, well, that just means the rest of the NASDAQ stocks are really participating. So we're seeing more broad participation with that. Small caps to the S&P, small caps have been doing pretty good now that there's this idea that the Fed is going to cut interest rates and probably continue to cut rates as we finish out 2025. Small caps like that. They're improving, but you can see in the bigger picture, there's a long way to go. But we've seen this ratio improve only to have the hopes dashed, and then this ratio continues to go back down. Then that same ratio, which is in red here, and then comparing it to the blue, which is the S&P 500 itself, how the S&P has been going up as this ratio has been going down. MegaCap growth, these are the big stocks that really drive the market here. Still above the 50-day moving average, still in an uptrend, looking positive there. And then MegaCaps to the equal weight. Now slowing down a little bit here. We came down to the 50-day moving average, have now tested that a couple of times with this ratio. But in the bigger picture, this continues to be in an uptrend. But as this was coming down in August, causing a little bit of a concern here. So we're watching this. And the robotics and AI ETF, just looking at it all by itself, still holding up at the high end of the rainbow, but not really breaking out with this one. Then we do a ratio, though, of the robotics and AI ETF with the tech sector. Not really outperforming, just kind of humming along here at the lower end of the rainbow. And the small caps to tech sector, very similar to what we saw with the small caps to S&P, an improvement here, but a long ways to go to repair some damage. Then the Dow Jones Composite Average, which is the Dow, the transports, and the utilities together, still looking pretty solid as a group. The semis to tech ratio, we want this ratio to really be going up. We want semis to do well. But we want them to do even better than tech. And when this ratio is going up, that's what's happening. A lot of choppy right now, not really showing awful lot of conviction. Low volatility. This is more defensive areas of the market here. Pretty much going sideways, but continuing to be in an uptrend. Where it's more encouraging, though, is when we look at a daily chart of the low volatility ETF to the S&P. When this ratio is going down, that means the market is not becoming more defensive. It's actually becoming more offensive. And you can see when we were really going down in 2022, this ratio was really going up. And then when we finally bottomed and started to come down with this ratio, that's when stocks reversed and started to go back up. All world stocks, but we take out US stocks here. Looking pretty good all by themselves, but we put US stocks back into the equation. This shows that US stocks are still underperforming world stocks. Energy sector to tech sector, still going down. That's energy underperforming. Now, energy was really going up, but it fell back this week and it's coming back down to the 50-day moving average and still in a downtrend with the ratio. And then the tech sector to the 10-year yield shows how the tech sector is outperforming here. This is an inverted version showing how the 10-year yield is underperforming the tech sector. And that's what you see in a healthy environment. Not like we saw back in 2022 when this was going up. This is continuing to go down now. And growth stocks to bonds, where we're seeing a little bit of a pullback here because now you're wondering, okay, is inflation a problem? Is the economy going to get weaker? That's when you want to consider getting into bonds. Now, we don't know that yet. We'll really only know that in hindsight, but there's some people out there that think the economy is going to run into some trouble. We're seeing weaker employment numbers, and now's the time because interest rates may have topped out and they're going to keep going down. That's when you want to get into bonds because bond prices are lower at that point and they go up as interest rates go down. So we're seeing a little bit of a threat here, but in the bigger picture, growth is still outperforming government bonds. Discretionary. This is one of the more encouraging areas of the market. We're still seeing it outperforming. Now, if you go back to 2024, and I've been bringing this up over and over and over again, we had the end of the world day here. And then once we got done with that and got into September, discretionary really started to outperform staples, and that continued into the end of 2024 and even the beginning of 2025. Then it took a dump with everything else as we were going down into the lows in April. We were improving and then just kind of coming along, coming along, coming along. Now we're starting to see a little bit more conviction here with this, and that could be positive. And that's Amazon, that's Tesla, and that's more of a growth area of the market. If this ratio continues to go up, that's more positive. And staples are underperforming discretionary. Staples are toilet paper and toothpaste. When the market's getting more defensive, staples outperform, like we saw earlier in 2025. Then when we finally got through all of that and the market started going back up, we saw this ratio going down, which is still, for the most part, what it's continuing to do. Gold to the S&P, breaking out a little bit because the S&P was up 1/3% this week. Well, gold is breaking out right now, and that's why we're seeing this coming back up lately. And then the dollar's been going down and gold's been going up, and when that happens, this ratio goes up. Then we look at the advanced decline line across a number of different indexes. Still looking good, still above advancing moving averages across all the indexes that we follow. And just coming off of recent all-time highs with the Dow, but that's not been confirmed when you look at the transports. That would be a Dow theory non-confirmation. And the perma bears pick up on that. And of course, since they're doom and gloomers anyway, this just supports that idea. Instead of saying, okay, well, the Dow's doing pretty well and maybe the transports will start to improve. No, they don't look at it that way. They're like, non-confirmation here, 50% decline, better head for the hills. All right, now I also include the utilities as part of Dow theory, which a pure traditional Dow theorist wouldn't probably not do. But we set a high here with utilities right at the beginning of August, and they've been pulling back as well. Now, you can make a case that utilities are growth because of AI, because of crypto mining, because of all these needs that we have now for electricity. But typically, utilities have been, widows and orphans. They pay good dividends. They're usually stable. Well, okay, that would make them more defensive. So that's why we just follow this and kind of just keep an eye on what's happening with the utilities. Look at the ratio between the Dow and the transports, not really showing much of a change here, just kind of range bound with the ratio. The transports not really breaking out, not really breaking down right now. And then the transports to the S&P, where they were really underperforming, they seem to have stabilized just a little bit here. And then we look at a correlation. Now the correlation is usually pretty strong. We're almost always up in this red area when we look at the S&P to the transports. And it's kind of breaking down a little bit here. We've been going sideways with the transports as we've been going up with the S&P for the most part. And that's really setting this correlation headed down. And then instead of using traditional Dow theory, we swap out the Dow and we bring in the S&P 500, which is just recently, it set an intraday high on Friday, but not a closing high. But we're not quite there with the NASDAQ. Now the NASDAQ's doing well, but it's underperforming just a little bit. If you're more positive, it's like, well, maybe the S&P is going to help the NASDAQ go up. If you're more negative on things, it's like, look at this negative divergence, head for the hills, 50% decline. Then to break it down a little bit more, instead of using the S&P weighted index, we use the equal weight version, just coming off of a recent all-time high, but has been pulling back and underperforming a little bit lately. And we did set a high here at the end of July with the equal weight QQQs, which is the NASDAQ 100. And you could also make a case for a negative divergence here, but we're not really seeing anything in other areas to really confirm that. And the FANG index, these are the big stocks. And this was Google and this was Apple. They're included in this index, setting an all-time high in Friday's session. And the Wilshire 5000 just coming off of a recent all-time closing high, as well as a recent high here with the total US stock ETF. ARK's been going sideways lately, but it was improving here after it spent the last few years just really disappointing folks, especially folks that got in right about here at the end of 2020 into 2021, buying here at the top because, hey, look at this chart. It looks pretty solid. It's in a really good uptrend, and then it just tanked after that. All right, the NYC composite looking pretty good, solid above both moving averages. All stocks, which are U.S. and international stocks, still looking good, but international stocks are outperforming. Emerging markets in a pretty solid uptrend here, looking pretty good in that regard. Bitcoin is still underneath its 50-day moving average, but it's still above the 200-day moving average, and we're still in an uptrend. The Japanese Nikkei, not too far off of recent all-time highs. And the microcaps, really small stocks, they're looking pretty solid too, and they continue to be in an uptrend. High leverage loans, this is another economic barometer, still above the 50-day moving average, still in a pretty solid uptrend, looking pretty good for the time being. Semiconductors, not really doing all that great, but not breaking down either. A lot of sideways action over the last few months. And then this is that same chart, but showing it on a rainbow here. We're still at the high end of the rainbow overall. And then AI and tech ETF, this is different than the robotics and AI ETF. This is actually a little more solid here, just coming back up here, not breaking out, but not breaking down either, but still in an uptrend. And we look at home builders. Now, they like it when interest rates are going too. That's a very highly interest rate sensitive part of the market. And so they've been going up here as the S&P's been going up, and we're seeing a pretty strong correlation between the two currently. And we look internationally. This is long term. This is a KST, which sometimes it's like, what, huh? Because it's such a long-term oscillator. It takes a considerable amount of time for this to really switch from negative to positive or positive to negative. But when looking at this, we have China, which is in an uptrend here, starting to see more of a downtrend with emerging markets. Now you look at the daily chart, we're looking fine there, but this is longer term. We're actually in a downtrend in Europe here. And then Japan rolling over a little bit, and we're still in a downtrend, even though we've been going up in the US here and setting recent all-time highs. The KST is picking up some weakness. All right, then a monthly chart of stocks to international stocks. Still longer term looking positive and really flattening out here with the PPO momentum oscillator. But this is longer term and it hasn't turned negative. It's mostly when we got into 2025 on the daily side, that's when we started to see US stocks really underperforming global stocks. And we look at bonds and stocks. This is the price of the 10-year. You can see we're getting pretty extended here with the RSI. We're looking good from a momentum aspect when you look at the MACD, and we are in an uptrend here based on the 50 and 200-day moving averages. And the total bond ETF daily chart looking pretty solid there. These are bonds based on price. A monthly chart. Now, bonds had a better week than stocks, and we're just starting out with September. So we're seeing this coming down just a little bit. This won't be completed until the end of September, but overall, we still see that stocks have been outperforming bonds longer term. And then this is the Pring World Bond Index, just really, really choppy over the last few years, but not really breaking out, but showing a little bit of strength recently. This is a daily chart showing how bonds continue to underperform stocks. High yield bonds, junk bonds, doing quite well, just coming off of all-time highs. Investment grade bonds, more conservative, also looking pretty solid right now. And you see a lot of this real move up, a gap higher. That's because Friday's employment report was weaker than expected. And there's a lot of people out there thinking, is it time to get into bonds now? Is the economy getting ready to really slow down and actually show some real negative weakness coming along? Well, there's a group out there that thinks that's the case. And so we see bond prices going up. And the Dow Jones corporate bonds also looking pretty good, going up. And then the stock to bond correlation. It was really strong right at the beginning of the month, meaning they were going in the same direction at the same time. A little bit of a pullback as we saw bonds going up and stocks were up not very much this past week. 10-year treasury yield. And the takeaway here is that after 40 years of setting lower highs and lower lows, now we're starting to establish a higher range, which is more the norm historically. The exception has been the last 40 years. So that's why I like to keep an eye on this chart. You can see how interest rates across all the different maturity levels here just really have been going down. And then we're dropping here with US on a weekly basis, and UK rates are pretty much staying the same. We're keeping an eye on the red area here. That's Japan. That's what caused the problem a year ago. And we're seeing if interest rates going up there is going to cause a problem again this time if they continue to go up. Junk bonds looking pretty solid here. And junk bonds are outperforming government bonds. And the riskier bonds, not really seeing much. We're at the low end of the rainbow here. Not really outperforming according to this chart, but not really underperforming all that much. You would give a little bit of a slant over to the underperforming, because usually when this is really going up, that means junk bonds are outperforming. And we've pretty much just been going sideways here. And then the S&P 500, the short-term bonds, still at the high end of the rainbow there. And then this is an inverted version of another chart that I look at. This is bonds to stocks. And this shows, even though we see the blip up here, in the bigger picture, bonds continue to underperform stocks. The S&P 1500 to short-term bonds, stocks are outperforming. You're going to see the same thing going through this. A broad market measure to 3 to 7 year bonds, still looking pretty solid there. The tech sector, a little bit more weakness here as growth has been underperforming as we work our way through the summer months, but still looking positive overall. And then the S&P 500, the 10-year yield, the S&P is outperforming. And then a long-term look at the 30-year price of the bond, the TLT, that is actually improving, but still below a declining moving average. And we're still seeing here with this ratio between the long-term bond and commodities, that's still showing how bonds are underperforming. Different sectors, materials, still above the 50-day moving average. A recent golden cross back in July, not really showing an awful lot of conviction, but it is in an uptrend. But when you compare it to the S&P, underperforming, but we are seeing a bit of a recent bounce here and trying to get back above and stay above the 50-day moving average. Communication, this is the big growth area of the stock market, setting all-time highs here and actually doing pretty good. We've been range bound with this ratio going back even to the spring and into the summer. It's still held on to being in an uptrend, and we're starting to see some weakness towards the latter part of July, but now this has been improving again, and that's more positive for the market. Energy, just all over the place. Enough above the moving averages here to generate a golden cross. Then, of course, right about the time that happens, we fall back down to the moving averages. But when we compare it to the S&P, we're really underperforming. We were seeing some hope there as we were working our way through August. Now it's starting to show some weakness again. The industrials just hanging out around their 50-day moving average and not really showing a lot of improvement here. This tends to be more cyclical. And latter part of July into August, we saw a breakdown a bit in the shorter term. Now, longer term, we're still doing okay with the trend, but this is showing a little bit of weakness. So we'll just keep an eye on this one. The financials, they got hammered in Friday's session, but they're doing okay when you look at them by themselves. And the improvements that we were seeing when we look at the ratio between the financial sector and the S&P, that was pretty much given back in Friday's session. We were starting to see this improve after we started to see a decline here, and that's a bit of a concern. We want the financials to actually outperform the S&P. That's not what's happening right now. So that's a little bit of a concern there. Then we look at the tech sector coming down to its 50-day moving average, and so far that's been holding and coming back up a little bit, still in a bigger picture uptrend here. But again, we got into August and we started to see this ratio coming down. It's trying to improve, but we need to get back above the 50-day moving average. Staples sideways right now, but when we compare it to the S&P, underperforming. When this ratio is going up, that means the market's getting more defensive. And we see little blips along the way here, but not enough to change the longer term trend. Real estate, it was up on Friday because employment was weaker than expected and interest rates went down. And it likes that. It was up over 1%, but just a lot of sideways action right now and really underperforming when we compare it to the S&P. Utilities, actually seeing some weakness here, starting to come down below its 50-day moving average and starting to even show more underperformance. Now, this recent top came in August. Now, it was doing better, and then it started to fall back. Then it started to bounce back up. Now it's been starting to go back down again with the ratio with the S&P. And I haven't been showing this. I used to show this every day in the daily video, but we've been seeing so much chop that the S&P to utilities ratio really hasn't been giving us any insight. Well, we saw a little bit of a breakout here. And then healthcare, a defensive area, came up to, it cannot seem to get back above its 200-day moving average and really underperforming when we compare it to the S&P. Discretionary doing quite well, not quite back to these previous highs that were set back in 2024. We'll see if this can continue to improve and improving, but still in a downtrend when we compare it to the S&P 500. Semiconductors, the SOX index coming back and reclaiming the 50-day moving average and holding at the 50-day moving average here with the Dow Jones Semiconductor Index. So semis are not leading, but they're not falling apart either. And then the semis to Dow ratio, I'm seeing a little bit of a gyration lately with this ratio overall. We're still below the blue line. It would be even more positive. That would mean semiconductors are outperforming the Dow, which they haven't been doing lately, as we've seen a little bit of a stall with this ratio. And then we look at intermarket analysis. Gold breaking out after being range bound for a lot of the year, doing the best. Then we have stocks in second place, where commodities and bond prices are about even now. Energy is back down to being negative year to date, and a lot of that's happening because of this green line, which is the dollar, which has been the worst performing asset in 2025. Then some correlations here. Working our way back up to neutral, but as you see the S&P going up and the dollar kind of going down, okay, they have a tendency to move in opposite directions. Well, the dollar's been stabilizing here a little bit, but not really going up either. And so they're still having a tendency to go in opposite directions. The S&P to oil, they were going in the same direction there for a while, and we've seen oil really coming down as the S&P has held on to its gains. And so we're seeing this correlation start to shift, showing that they're having a tendency to go in opposite directions here. And they were really going in opposite directions when we look at the S&P to the 10-year yield. Now we're seeing that correlation start to strengthen a little bit here. And then the S&P to the 2-year yield, opposite directions, that working its way back more to neutral. And the tech sector to the 10-year yield, that's coming back up into this neutral area. Long term, monthly chart of the NYSE, still looking really solid here. But the copy curve, it rolled over at the beginning of 2025 and it's continuing to go down. So the momentum is still seeing some weakness that hasn't come back over to positive yet. Another monthly chart of the NYSE, and we're still going up here with the NYSE record high percent index, and that's positive when this is going up. Then a monthly chart of the S&P, still above the moving average, still going up with the PPO. And then we look at the S&P on top, and then a longer term ratio between stocks and commodities. And this is kind of lining up with the inflation deflation area that we saw earlier, where stocks are still underperforming commodities longer term. But on the daily chart, stocks are outperforming. But we look at commodities and they've been going sideways. Then another US to global index here. Longer term, still above the moving average, but the KST, which is the momentum oscillator, continues to decline. Then we go through, and I'm not going to read all these off. Everything here is positive, and you might just want to pause this and look and see. And then Bitcoin is at the very bottom. But these are all the positive areas of the market. And then we go over to the negative side. It's the dollar. That's pretty much it right now. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.